Welcome back to the Wall Street Podcast. Today, we're doing a deep dive into a key piece of research from Morgan Stanley. It's their U.S. equity strategy data pack, August 2025, which just came out on August 8th.
That's right. And it really gives a pretty comprehensive view of the U.S. equity markets. They're looking at the current bull market, earnings trends, valuations, sector outlooks, the whole picture.
So what's the core narrative here? What are they really highlighting?
Well, the big headline is this new bull market. It's only about 4 months old, they say, emerging from that bear market bottom back in April 2024.
Which itself followed that sort of rolling earnings recession starting way back in early 2022, right?
Exactly. And the driver for this recovery, they point specifically to a V-shaped improvement in earnings per share revisions breadth. A pretty sharp V bottom, actually.
Interesting. So they're generally bullish looking out 12 months.
They are, yes. But they do inject a note of caution for Q3. They're anticipating a modest pullback.
Okay. Why the caution in the near term?
It seems to be tied to lagged impacts from tariffs hitting growth data, both macro and micro, plus, those persistent inflation fears potentially keeping the Fed on hold.
Right, so the Fed's staying put longer than maybe the market hopes. A near-term speed bump, perhaps?
Precisely. A bit of near-term risk against that longer-term bullish backdrop.
Okay, let's dig into the earnings and valuation details then. You mentioned that V-bottom in EPS revisions breadth.
Yes, that's a key signal for them. And their proprietary leading earnings model has also turned constructive, which supports the positive outlook.
And how are those revisions looking across different types of stocks? Still concentrated?
For 2025, yes, very much favoring the Mag 7 big tech names. But looking out to 2026, the spread narrows quite a bit, suggesting maybe a broadening recovery later on.
And valuation-wise, where does the market stand?
The S&P 500 is trading around 22 times next 12-month PE, and the equity risk premium remains historically quite low.
So investors aren't demanding much extra return for holding stocks versus bonds. Confidence or maybe something else?
It could be interpreted either way, right? Confidence in future growth, or perhaps a sign the market's a little rich, a bit exuberant.
Makes sense. And how about market structure? Anything interesting there?
Well, they note stock-specific risk fell quite sharply after what they call Liberation Day, presumably meaning peak uncertainty passed.
Liberation Day, okay. A bit dramatic, but I get the point. Less individual company noise.
Exactly. And dispersion in returns, earnings yield, and estimates are all currently below their long-term averages. What's really striking, though, is the performance gap.
Between market cap and equal-weighted indexes.
Yes, particularly in comm services and infotech. Market cap-weighted indexes have massively outperformed equal-weighted ones, both year-to-date and over 12 months. Really highlights that mega-cap concentration.
Underscores the Mag 7 point again.
Yeah.
Okay, so how does this translate into their sector calls? Where are they overweight?
They like financials, seeing potential for M&A to normalize, loan growth to rebound, and valuations look attractive relative to history. Industrials are another overweight. They see benefits from domestic infrastructure spending and general capital expenditure. And energy.
Energy. Why overweight there?
They view it as a valuable geopolitical hedge. Plus, strong free cash flow margins look appealing.
And on the flip side, the underweights.
That would be consumer staples and consumer discretionary goods.
Why specifically those two consumer sectors?
The report points to poor pricing power, some tariff risks, and generally low consumer sentiment, likely weighed down by those higher interest rates. It's just a tougher spot for them right now.
Got it. And the equal weights? A mix, I assume.
Yes, quite a mix. Technology is equal weight. You have the AI productivity story, but maybe some near-term budget headwinds.
Yeah.
Utilities are there too, benefiting from Gen AI data center demand and traditional CapEx. Materials are equal weight, seen as cyclical, tied to global growth. Communication services is interesting, dominated by large caps, but they suggest watching the equal-weighted performance there. And healthcare, historically defensive, stays equal weight, though they do note some areas like biotech remain attractive.
Okay, let's pivot to our commentary segments. First, digging deeper into this new bull market's foundation. We touched on the V-shaped earnings recovery, but what other specific drivers does Morgan Stanley see sustaining earnings and cash flow over the next, say, 12 months.
Sure. Beyond those EPS revisions, they highlight a few key things. Positive operating leverage is one, companies getting more profit from each dollar of revenue. Widespread AI adoption is seen as a major productivity booster across the board.
Okay, AI is a big theme. Anything else?
Yes, they also mentioned potential dollar weakness as a tailwind for U.S. multinationals, plus cash tax savings coming from the OBBBA legislation. Add to that, easier growth comparisons year over year, and quite a bit of pent-up demand still lingering in various sectors. So it's a multifaceted argument.
A fairly robust set of drivers. Now let's address that near-term pullback concern for Q3 again. What are the absolute core reasons for that expected weakness, and how exactly do inflation and the Fed fit in?
The main culprit cited is the lagged impact of tariffs. Even if they're modest, the effects can take time to filter through into both the macro data and company-level results. That's the primary drag they see for Q3.
And the Fed's role?
Well, the concern is that inflation, while maybe moderating, remains sticky enough that the Fed stays on hold longer than the market currently anticipates or wants. That uncertainty about the path of rates definitely contributes to the near-term risk profile.
So navigating that short-term data and policy noise against the more positive medium-term trend.
That sums it up pretty well. Confidence in the 12-month view seems strong, but they're flagging this potential bump in the road.
Understood. Now, thinking about our listeners, how does this high-level market analysis translate to the general public? What are the potential impacts on everyday life?
Well, on the positive side, if this broad economic recovery holds, it should support the job market and maybe boost overall consumer confidence. That's good for everyone.
But there are risks, too.
Yes. Those tariffs, for instance, even if they seem small in percentage terms, could mean slightly higher prices for imported goods you buy every day. Think electronics, clothes, maybe some food items.
And interest rates.
Absolutely. The Fed's actions, driven by those inflation concerns, directly influence borrowing costs. So this affects mortgage rates if you're buying a home, car loan rates, credit card rates, and the cost for businesses to borrow and invest.
What about AI? That keeps coming up.
Right. The accelerating adoption of AI isn't just some abstract tech trend. It could genuinely reshape jobs, creating new ones, changing others. It could also drive productivity gains you might see in faster services or smarter products. It's becoming more tangible.
So wrapping this up, this deep dive into the Morgan Stanley report really highlights a market in transition. We seem to be in a new bull phase, backed by recovering earnings.
But with clear near-term hurdles like tariffs and monetary policy, uncertainty still very much in play.
Exactly. It underscores the need for vigilance, even with a generally positive outlook. The economic landscape is definitely dynamic right now.
Yeah.